It's a miserable life being a short seller. They take the blame, and sometimes worse, at least in China, when markets fall. No one ever celebrates the role of short sellers in making the market soar. And today looks like a classic case of short selling helping to boost the market, as Japanese stocks had their best day since 2011, rising by 6.4%. Nikkei 225 average did even better, leaping 7.7% for its best day since 2008, probably helped by the tendency of what are rudely called macro tourists to bet against shares in Japan by using Nikkei futures. Now, there were some good reasons for the bounce. Positive, if not very detailed, talk of stimulus from China and a repeat of Japan's pledge of a corporate tax cut. But the scale of the move can be explained only by short covering, the buying back of stock by those who had been betting on a fall. And the rest of the world's been rallying too today, but nothing like as much. And there's good reason for the difference. Japan had fallen a lot further thanks to the reflexive strengthening of its currency, which happens whenever global sentiment turns sour. Stronger yen feeds through immediately into weaker shares. Now, this is clear if we look at Japanese against US shares in common currency terms. On here I've put the S&P 500 in blue in yen terms, and against that the Nikkei 225 in red, the main Japanese index. Now, the two moved remarkably closely together once adjusted for the currency over the panic of the past month or so, as you can see, until just a few days ago when they really diverged by quite a bit. So another way to look at the size of the Japanese rebound is as just a catch-up with the US, although, to be fair, there's no particularly good reason why the two should move especially closely together. Still, the rise in shares everywhere today does suggest that investors are thinking of the glass as half full. Bland statements from China could have prompted disappointment just as easily as optimism. So the positive moves in markets suggest that sentiments become so depressed that investors are once again ready to look on the bright side of almost anything. Now, this shows on here one measure of sentiment, the gap between the Investors' Intelligence Survey of bullish writers of investment newsletters and those who are bearish. As you can see, it's absolutely plunged in the past few weeks, and the bears now outnumber the bulls, so the one minus the other is now negative. Now, other surveys also suggest that bullishness crumbled as the summer wore on, while US options markets saw a surge in those buying protection against falling share prices, a surge not seen since the brief panic back in 2011. Now, all of this could be trumped by really negative developments, and we could see, of course, then shares resume their decline. After all, sentiment has been an awful lot lower. The gap was the bears outnumbered the bulls by 20 percentage points back in 2009 over there, and even in 2011 it was worse than now. But with sentiment starting to improve on some measures from what's a relatively low level compared with recent years, it's going to take news which is unequivocally bad to knock the markets off course again in the next few weeks.